Everyone dreams of living an uncommon life, and the best asset you have to achieve your dreams is you. Welcome to the Uncommon Wealth Podcast. We're going to introduce you to people who are living uncommonly. We're also going to give you some tools and strategies for building wealth and for pursuing an uncommon path that is uniquely right for you.
Hello and welcome everybody to another episode of the Uncommon Wealth Podcast, where I'm your host, Phillip Ramsey. Today we have a guest, a very smart guest, with one of our managers that we like to put money with. It's called ETF. It's Brent Uhlenhopp with Simplify. So Brent, welcome to the show.
Hey, thank you, Phil. Happy to be here and looking forward to having a great conversation today.
Yeah. Okay. So I want to kind of dive in on you as a person first, and how did you land with Simplify? Is this always something you wanted to do from the first moment you woke up when you, in your first grade year, like, I want to work as an ETF manager. I want to do some kind of finances. Was that your background? What was it? Let's talk through that first, and then we'll dive into Simplify.
Right, absolutely. And, obviously I think growing up, I was like most or many kids in America, I wanted to be an athlete, be in the NFL. I thought it was going to be some type of superstar. So always kind of had that, alpha personality a little bit. And I think, as I went to school, I went to the University of Iowa, did business school there, and really didn't know specifically what I wanted to do. I knew I wanted to, interact with people and be in an occupation where you could make a good living. Didn't want to go to school my entire life, to be, a physician or something like that. So I kind of ended up in the city where I landed after college. Des Moines, Iowa is a very heavy finance and insurance kind of background. So it was kind of a natural trend for me to end up at, first off, Wells Fargo, where I did a couple jobs.
Uncle Wells.
Exactly. Uncle Wells. Everybody's been there, and some have fond memories, some do not. So I did a few things right out of college there, kind of in the mortgage and banking realm, and got my, foot in the door, got some experience, built the resume up, if you will. And then in 2008, I joined Principal Financial Group, where I spent the vast majority of my career, is about 15 years there.
In what form there? What were you doing?
So initially I started in our insurance side, or in their insurance side, I should say now. It's been so long, I was there for so long, I keep saying us, but it's them now. So started in their insurance side, worked there for about 4 years. And right when I started was right about the time the 2008, 2009 global financial crisis hit. So that was quite an experience. Fortunately for me, I was young and just out of school, so I didn't, have a ton of accumulated wealth. But that was quite an experience because Principal at that time had laid off about 10% of the workforce, and I managed to survive that primarily because I was in a sales and marketing type of a role, and those were typically the last positions they cut out. So very fortunate on that front. Spent about 4 years there, went over to their investment side. Principal Global Investors specifically is the kind of the department there, and worked in our distribution, or in their distribution area, basically wholesaling, if you will, the terminology, or selling to financial advisors our investment products, mutual funds, ETFs, and some other similar pool investment vehicles, and did that, like I said, for about 15 years. And how I became aware of Simplify, which is this pretty much brand new company. We're about 4 years old, founded in 2020. Our CEO and co-founder, his name is Paul Kim. He's an industry veteran, very well known in the ETF world. He spent 5 years at Principal and helped to launch and develop their ETF distribution from 2015 to roughly 2020 when he left to start Simplify. And that was really how I became aware of Simplify. And a few colleagues of mine from Principal joined, and I eventually went over last summer in the middle of 2023 for really a new change and to try something new, just with the opportunities that presented themselves and basically fell in my lap. I thought it was a once in a lifetime opportunity for my career development to kind of take on something new and innovative. I'll leave it at that.
Yeah, Brent, I want to go back to that, but let's first just kind of talk through just the ETFs and the mutual funds. There's a lot of things that you're saying that some of our listeners be like, what in the world is he saying right now? But before we go into that, has it been a good transition? Are you happy you made the switch?
Oh, absolutely. Yeah. I couldn't be happier.
Could you imagine you'd be like, no, I hate it actually. This is the worst thing ever.
Exactly. Okay. As somebody, on the management team listens into this somehow. But right. No, I couldn't be happier with the move. It's been, a lot to take in, but it's been a phenomenal learning experience really for me, going from, Fortune 500 America, principal, 150 years almost of existence, to a new startup essentially. And getting really involved in a lot of the different aspects of a business, an investment management business that I never had any, privy to basically at principal during my time there. So it's been very new and exciting, but a great learning experience. And
Simplify. The reason why we like you guys is you do things very differently. I would say let's just go after it and say uncommon. But let's start talking about the ETF world, because there was a lot of times back in 2008, mutual funds were the thing. They were basketing all these kind of stocks and investments and kind of putting it in, and then you had to trade it. It's kind of confusing. But let's just start talking about mutual funds, and then why did Simplify go to ETFs? And what are ETFs? So let's start with the mutual fund. We can talk through that a little bit, and then we'll move to what are ETFs.
Right. So ETFs and mutual funds are similar in some ways and then obviously different in other ways. So in general, mutual funds and ETFs, or exchange traded funds, are pooled investment vehicles. So the most common example, and probably what many in the audience will understand, is take a large cap mutual fund or ETF of the S&P 500 companies. So you basically have this pool of all, say, 500 companies. Some will whittle it down to just the ones that they like. And you basically have that in this wrapper, whether it's a mutual fund or an exchange traded fund. So you have more diversification. If some of those stocks do poorly while those do well, you basically kind of average it out and just have, again, more of a diversified portfolio. I think, modern portfolio theory is something most financial advisors like yourself, implement in things with your clients. So in a nutshell, mutual funds and ETFs are similar in that they're a pool investment vehicle for a particular, market. You can also do it in things like bonds and commodities, what have you. Really, the advantages of an exchange traded fund or an ETF over a mutual fund are daily liquidity and daily trading on the exchanges throughout the day. So you're able to basically trade it like a stock throughout the day as the market, is trading. You also have typically more tax efficiency, and you typically have a lower cost relative to a similar mutual fund. So for those reasons, I mean, as an example, if you recall in 2022, pretty rough year for stocks and bonds. Mutual funds, specifically, like if you look at a large cap fund, you may have gotten a capital gains distribution for double digits in 2022, while that fund was actually down double digits. So that didn't make sense. I think it doesn't really make sense in a lot of investors' minds. And that's one example why an ETF or an exchange traded fund is what we consider kind of a better mousetrap to invest in a similar asset class or strategy, but to do so more efficiently and effectively.
Right. Because mutual funds, you say that you want to get out of it, let's say, because this is the verbiage that my listeners, you want to get out of this trade, you want to get out, you want to get your money out. Well, then it has to wait till the end of the day to figure out what that price of the wrapper or all the investments are in it. You have to wait. Well, exchange traded funds, like you can do that like right when you want to get out. Like they could go to market and you can sell it. So that's one of the reasons. I also too think it's just a little bit more cost efficient as an ETF or exchange traded fund versus a mutual fund. So I would agree with all those things
Absolutely.
You said. Cool. Okay, so now let's talk through Simplify. We have Paul Kim, who's rocking and rolling.
Yes, sir.
How long? It's been 4 years, right?
It's been 4 years.
Okay. And what was like the initial brainchild of like, we got to do this? Usually it's like one investment that this is going to be great. And now it's morphed into many other things.
Right.
But what was that one thing that Paul thought?
There were a couple primary reasons that Paul and the other co-founder of Simplify, Dave Burns, created the company. First and foremost, there was a regulatory change with the Investment Company Act of 1940. So that's basically the SEC legislation that kind of oversees these mutual fund and ETF products in general. There was this rule change called 18F-4. I won't get too much into the details, but this part of the rule, or this rule change, enhanced this Investment Company Act back in 2020, beginning of 2021, and allowed for mutual funds and ETFs and in general these pooled investment vehicles we've been referring to better utilize and implement derivatives into these types of strategies. And by derivatives, many may be familiar with options or futures. These are synthetics of the underlying security or the underlying stock or bond, basically. So being able to do that allows companies like Simplify and many others out there that have sprung up over the past 4 years to generate portfolios with higher income, with lower drawdown risk, with less volatility, to be better diversified against a typical 60, 40, or 60% stock, 40% bond portfolio.
Right.
So I think that was the overriding factor that Paul and Dave and the folks at Simplify utilized and took advantage of to start this company. They saw kind of the writing on the wall that there was this opportunity out there. And another ancillary factor was just the fact that where Paul was at my former employer, they at the time were not kind of the innovators, if you will, or weren't really interested in launching these types of very, some would say, higher risk types of strategies, very complex, types of products. So, those two things I would say were the primary factors of why Simplify really got off and running, if you will, in 2020.
It's Principal Financial Group.
Yes.
It's Manila to the T. Like they just, oh dear. I started at Principal.
Nice.
Funny. Yeah. So I love it. So that he sees an opportunity, and derivatives are powerful, but they are confusing if you don't understand them. So I could see like a big company like Principal, like I don't want anything to do with it. Tried and true. We're doing what we know it's past. But I like the people who see an opportunity and then figure out the opportunity and let other people access the opportunity,
exactly.
Which is basically what Simplify has done.
100%.
Okay. So you get into the derivative world, you step into this, Paul and then Dave Burns, they get together. They're like, hey, let's start this bad boy.
Yep.
And they say, okay. So how does that even start? Like, where are you based out of? Are you based out of Des Moines?
So technically our headquarters, but you don't necessarily have a brick and mortar office per se, because most of us work remote, like yourselves and like your Aaron. New York City was where a lot of our kind of beginnings took place, and Las Vegas now is where Paul lives. So Dave is in New York, Paul is in Las Vegas. So technically those are kind of our co-headquarters, if you will. But the employees, myself and roughly 40 or so that make up Simplify today work remotely from our home offices, and we're spread out throughout the country. And a lot of industry veterans from both traditional asset managers like Principal Financial Group and myself. We have many others from, other well-known firms like PIMCO, for instance. Yeah. And then some kind of from that institutional and hedge fund world. Where at Simplify, we're trying to bring institutional and hedge fund style investments to everyday investors.
That's right.
And, just an example that we like to throw out there, you look at the Yale Endowment, for instance, and Yale is very well known for using alternative investments and private types of assets that retail investors and oftentimes retail advisors even
can't
are able to access, right? So, you just look at a trailing 20-year history, for instance, and they've outperformed, the Yale Endowment has outperformed, the 60-40 stock and bond traditional portfolio by, 4% a year annualized.
Wow.
So just massive outperformance and massive opportunity. And that, again, was a leading factor in, Paul and Dave and the Simplify crew to kind of identify these opportunities where, retail investors have heard of these things. They want access to them. So if we can package them in an accessible wrapper like these exchange traded funds or these ETFs, it allows them to be implemented into portfolios, build better, more innovative portfolios with, higher risk adjusted returns, if you will. So that's, again, what we're trying to do. And we're trying to democratize, if you will, institutional investing and, again, bring that to the masses.
Sounds uncommon. I like it. Okay. So first off, you had one investment that people could step into, and now how many do you have currently?
Yeah, so we launched, I wasn't there at the beginning. I joined about a year and a half ago, but we launched initially kind of some what we called equity convexity strategies. So basically it was, an equity stock portfolio of the S&P 500 or something similar with either some call or put options utilized in there to help with upside or downside, kind of as markets moved one way, you could kind of amplify the returns. It's this concept of convexity, if you will. So you can use these derivatives and options specifically in this example to kind of magnify upside or downside in the markets. And that's kind of where Simplify started. And today we have about 30 ETF products and just over $6 billion in assets under management, very strong organic growth. In fact, There was an article out a week or two ago, and we were the second highest, or had the second highest growth rate amongst ETF companies today. So again, starting
That's
as a smaller
huge.
company, yeah, very huge. So
That'll
very
go
exciting.
parabolic on you quick.
I hope so.
Yeah.
Keep the trend going. But so we've again developed these different products, and a lot of our ideas come from investor demand or what clients want. We may start with an outcome we want. The S&P 500 with lower drawdown risk. So you hear a lot of chatter out there now about these buffered ETF products where you can still capture a lot of the gains of the market, but also have protection on the downside. And that's a concept that is often found in annuity products and other things where you might have lockup periods.
Right.
But with an ETF, you have that daily liquidity. So that's an attractive opportunity or selling point against
because everybody's like, describe your best investment. This is like annuities, like they love it. Describe your best investment. Okay, I get all the upside and no downside. Like that would be the best investment. Well, then we're like, oh, here's this annuity, like have it, and the upside is like dismal, the downside is protected, but it's like I want it to grow actually. And so that's what I think these buffered products gives you access to. Like maybe you won't go all the way down to the whole, maybe you get the first 20% protected on the downside, but you can get a lot of the upside. Now you might not get all of it, but you still have known assets and known investments that the S&P, like I know that. Where some of these annuities, they have like the Barclays Global hedge fund, like what is that and how is that? So it's very known investments that you can look up the tickers, this, that, and the other. So I like that strategy for some clients, especially for the ones that are like, oh, it's getting close and I can't afford the downturn. Exactly. That's something that we'll look into for sure. So.
Yep, cool. And in addition to that, a lot of what Simplify does, there's also this concept out there that's kind of innovative and cool, especially as we're getting close to Halloween. But this boomer candy concept where you have all of these baby boomers who are retiring, and by 2032, all of them will be 65 or greater. So a massive amount of wealth out there, and typically a baby boomer wants higher income, drawdown protection. They want lower volatility, but they still want to participate in the stock market. Of course, for instance, fixed income and bonds have been a challenge over the last decade plus, for many reasons. But this boomer candy concept, plays into what we do at Simplify and again, what other firms are doing similar to us. But, not only having this buffer, this downside protection available in an ETF wrapper, but also things that can generate additional income, which, most folks in retirement are looking for a steady income stream with the least amount of risk. And by using derivatives and things of that nature, you can build portfolios that, have higher income and all of the kind of the desired characteristics of what, this baby boomer generation is looking for.
That's really cool. Okay. And then, so the real reason why we wanted to have you interviewed is, so this is October that we're shooting this, and October is Breast Awareness Month.
Yep.
And you have a pink fund, it's called. So what is that? And tell us how that even started. Give us a little bit of background that way.
Yeah, absolutely. So the Simplify Healthcare ETF, its ticker symbol, as you mentioned, is pink. What it is, it's really the first pro bono, or essentially our portfolio manager, Mike Taylor, is doing it pro bono. We take the net proceeds of the investment and donate that to the Susan G. Komen Foundation. So for those that aren't aware, Susan G. Komen is a world-renowned breast cancer research institution. Since 1989, breast cancer mortality has dropped by like 40%, something, crazy like that. And it's something that typically touches every person.
Yeah, right.
I mean, 1 in 8 women will at some point have a diagnosis of breast cancer, which is insane.
Sad.
I mean, we both have daughters, obviously.
Yep.
Friends and family. So I think that is one thing that sets us apart and is very unique, is that we donate that, again, net proceeds to the Susan G. Komen Foundation. And since the fund launched, or the inception back in October of 2021, so it's been around just over 3 years, we've donated several $100,000 to the Susan G. Komen Foundation. Most recently, a couple weeks ago, we did a check ceremony at the New York Stock Exchange for $100,000 too.
Really cool.
So that right there, for those who are looking for an investment that, is doing better, for just the world in general, you might have, some who look at, those factors as far as an investment criteria. is one thing. And also the strategy itself has been a very, very strong performer in the healthcare sector itself. So the portfolio manager's name is Mike Taylor.
Okay.
He's a scientist by trade. He went to John Hopkins and was in the scientific community for a number of years. And then for the last 20 or 25 years, he's been managing healthcare, from both an ETF standpoint with us for the last few years. Prior to that was with a couple massive hedge fund groups where he did
cool.
healthcare there. And also ran a pretty large strategy at Oppenheimer as well. So very strong industry veteran, has a lot of connections in healthcare, but he's running this pink portfolio to not only outperform, but also to do better, for society in general.
That's cool. Okay, so I'm going to give you a little time just to what ticker symbols do you like? Because I know that some of our listeners will geek out about this and will go and look at them just to see, hey, Simplify, what is this? Let me see kind of a track record. Also know that this is for educational purposes. This is not for hey, this is what we're telling you to go buy. That is not what we're saying. So that's my disclaimer because I am the compliance officer for a company. So there you go.
Very good.
But what are the ones that you like? What are the ones that kind of get you excited? What are people kind of gravitating to?
Yep. Are you asking just in our lineup in general or within Pink?
No, with your lineup in general.
Yeah, perfect. So aside from Pink, we see a lot of interest in, again, some of these higher income generating strategies. I think one of our top ETF products is SVOL. It's SVOL. It's the Simplify Volatility Premium ETF, and it's more of an equity-like income product. It's a 5-star rated Morningstar strategy, kind of in that large cap space or that stock space that many are familiar with. But we're able to generate a roughly 15% distribution yield on that while still participating, with the majority of the stock market returns. So that kind of along the lines of that baby boomer concept, where we have a very high distribution on there has been very popular with, many types of investors out there. And several of our income products, we have a core bond, or basically what a core bond portfolio is. It's a portfolio of U.S. Treasury bonds, U.S. investment grade corporate bonds, and then these things called mortgage-backed securities, which are basically mortgage loans bundled and packaged and essentially sold off as kind of a pooled investment vehicle, similar to a mutual fund or an ETF. And we have a product, AGGH, AgH, which is our play on that core bond allocation, and we do kind of enhanced income overlay through the use of options and some of these derivative products that we've touched on a little bit. So I think those two in general, from an income standpoint and just from an asset class standpoint, where they fit into traditional portfolios pretty well.
Sure.
I think are two popular strategies that make sense or could make sense for you now, depending on, again, your risk tolerance and all that you go over with your financial advisor. But just again, two kind of our income products that have really had good traction for us.
So let's talk about the SVOL. How much are a fee for that? What's the internal fees on that?
Yep. So, with actively managed ETFs like we do at Simplify, you're typically looking at a management fee of 30 to 70 basis points. Specifically on the SVOL product, it's 50 basis points. So you're paying for that because we're doing some really unique, again, institutional available, things that are only available in the institutional world. And then specifically in SVOL, we are doing some things with shorting VIX futures. So VIX is the volatility index. It's basically the measure of implied volatility in the marketplace. So when the VIX goes up, typically stocks go down. We're able to do this kind of harvesting of premium in there. I'll keep it simple, but that's part of the kind of the secret sauce of how we're able to have this massive distribution. And to be unique and different, and be additive to a portfolio where we don't necessarily want to be the next large cap manager or provide that beta that you can get so easily out there, but to do something different.
And to remind the listeners, this is for a portion of your portfolio.
Absolutely.
It's not for everything. So shouldn't
certainly be based on risk tolerance and discussions with your financial advisor. Absolutely.
And then AGGH, what's that expense ratio?
That one is, I want to say 35 basis points roughly. So not quite as much or quite as high as SVOL. Typically in fixed income, it's not quite as, actively managed in a lot of cases. So that one, it kind of falls in that, around 0.5% a year roughly. And then
Simplify doesn't do it for free. You know what I'm saying?
Right.
Yeah, I get it. Okay. So what are you excited about in the future? What is in store for Simplify? Asset managers, the ETFs, what do you see in the future for Simplify?
We continuously are launching new ETF products out there, and we're also branching off into a couple other areas of the market that I won't get into. But, I think what's exciting is that we have these new products continuously coming out. We recently launched a municipal bond portfolio that has this income overlay on it. So that's one of our newer products. And, as we kind of grow and evolve over time, and we have more, ideas coming from our current investors, and just seeing what's of interest in the marketplace, we have the ability to really come up with, whatever's desired. And another thing we do at Simplify is we're able to, if we're not able to, maybe create that portfolio ourselves, we'll use sub-advisors or research partners to help us to develop and implement these products. As an example, we have what's considered kind of an alternative investment style product. It's a managed futures ETF that we partner with a hedge fund group out of Europe. And managed futures are really like commodities exposures and things that are not your typical stock or bond allocation. So things like that as an example, where we can, partner with others in the investment world to bring the best solutions to our investors.
That's good. Okay, so if our listeners want to reach out to you, Brent, how would be the best way to do that?
You can go to Simplify's public website. It's www.simplify.us, and there are several ways to contact us, via email or phone call. You can reach out that way. We have a very, intuitive and user-friendly website. So I would say that's the best way to get information and to, contact one of us if you'd like to have a further discussion or get more information.
That's perfect. Well, thank you for all your knowledge. Thank you for just Simplify, for stepping outside the box, seeing an opportunity and capitalize on it. We've been super grateful just to be able to have access to the investments that you have just in the portfolio. And so thank you so much just for being here. Thank you, listeners, for listening. Until next time, go be uncommon.
That's all for this episode, brought to you by Uncommon Wealth Partners. Be sure to visit uncommonwealth.com to learn more about our services. Don't miss an episode as we introduce you to inspiring people who are actively pursuing an uncommon life.